Thank you, everyone, and welcome to this week's speaker series. I'm happy to be joined today by Chris Simard from J.P. Morgan. Chris, thank you for joining us.
Excellent. Thank you very much for having me.
Chris, so you are part of J.P. Morgan's infrastructure investment team, and specifically, you're going to be discussing the J.P. Morgan Infrastructure Investment Fund or strategy, which is available to our brokers and advisors and investment professionals through the iCapital network, right? So give us briefly, first of all, a brief introduction to yourself, to your team, and what it is that your team is doing as part of their core investment strategy.
Yeah, absolutely. So my name's Chris Simard. I've been at J.P. Morgan for about 11 years now, almost all on the infrastructure investments team here at J.P. Morgan. We manage a $34 billion open-ended fund, which we think is one of the largest funds across private infrastructure as of today. The fund has been around for about 16 years now, and we have a team of 70 people that are solely dedicated to this one fund. So for us, this is all we focus on. There's no separate accounts, there's no vintages or other strategies, and it's primarily invested in the core part of infrastructure. So mainly regulated utilities and long-term contracted power, where most revenues are driven by the people on this call paying essential service bills.
Okay, so it doesn't constitute bridges, railroads, tunnels, those things, right?
Exactly right.
Okay, so it's a gathering from your track record. I saw going back since 2007, you've had 50 quarters. I think only 48 of them, only 2 quarters showed negative performance, right? So obviously, a lot of this has to do with the regulated nature of these infrastructure projects that you are investing in. Tell us why the team chose to focus only on these regulated entities.
Yeah, and there's a couple things that we focus on. So one is that regulated utility bucket, which makes up about 40 to 50% of our fund. So think water, heat, and electricity. So providing essential services to customers where you generally get a regulated return to do so. So it's the risk-free rate generally plus a specific spread. Now, of course, that caps you on the upside as well. So with utilities, you're unlikely to receive a 15 or 20% return, and you really shouldn't for owning a natural monopoly like that. But you definitely get the consistency of returns, and we've seen that over time. The other large part of our portfolio is contracted power, so wind, solar, and gas generation, where we have 10-plus year contracts agreed with investment-grade counterparties, where we produce power and they pay us a specific price for that power over a long period of time. So very limited commodity exposure across the fund. Most of the returns are regulated or contracted. So as you said, in the last 12 years, we have positive returns in every year and only 2 negative quarters of return in that period, with the worst being down 0.5%, and that was Q1 2020, the first quarter of COVID.
Right. So that's obviously a very impressive track record. Do you want to share with us some other key metrics of the fund?
Definitely. So again, as of today, $34 billion of equity value. We do use leverage at the portfolio company level. So when you're thinking about our overall fund, we own 21 private companies. There's no listed component at all to the portfolio. It is about $69 billion in total gross asset value. So 50% LTV on average across the companies, but that leverage is 80% fixed rate debt with about 8.5 years of average maturity. So you have mostly long-term fixed rate debt at the portfolio company level. When you're thinking about the geographies that we invest in, it's OECD developed markets only. So for us, it's US and Western Europe that make up about 90% of the portfolio. And the reason for that is your biggest risk in infrastructure tends to be political and regulatory. So for us as a core fund, we like to focus on the OECD. When you're thinking about return and yield relative to risk.
When you said OECD, because you mentioned Europe, Western Europe and the United States, but you also mentioned OECD. Yeah. Are there any countries outside of the US and Western Europe that you are invested in?
Yeah, a small amount. So we own a little bit in the UK, Canada, Australia, and Chile. So those are the kind of very minor positions for us, but I would expect most of the growth in the US and Western Europe.
Understood. Okay.
And then maybe just from a risk and return standpoint, we touched on the last 12 years, but in general, we've had a high single-digit net return to go along with 1.5% volatility in the last 10 years. And one of the key things with the volatility is, of course, the fund is only valued quarterly. So it's KPMG, Deloitte, and E&Y valuing on a quarterly basis. So looks a little bit different from what you see in traditional equities or fixed income that we can all trade on a daily basis. But at the same time, I think the low volatility is really driven by the diversification of the fund. So as an open-ended fund, it's taken us 15 years to get to this level of scale and diversification. And then just the fact that most of our assets are, again, water, heat, electricity, bills that people are generally paying regardless of the broader GDP environment. The last piece I'd mention is just the yield. We have a 5 to 7% target annual yield. We've been within that range over the past 10 years. So clients receive cash quarterly and then have a choice to take it or reinvest it back into the fund. So two ways to use the fund. One is a source of diversified income, and the other one is a way to get compounding consistent returns through time through the reinvesting option.
Okay. So Chris, a couple of questions that I'm sure are popping up on people's minds is with such a spectacular run and sort of steady returns, given the regulated nature of the entities, what happened in those 2 quarters to actually get a drawdown?
Yeah, absolutely. So one was Q1.
People still kept paying their powers, their bills. So what caused the drawdown in those quarters? Yeah.
Yeah, so the utilities and the power businesses actually were mostly fine, performing nearly as expected during COVID. Just as you said, people still paying their water, heat, and electric bills. The main issue was we owned 2 airports at the time. So 8% of the fund was invested in airports, and as you could imagine, almost zero passenger volumes at the airport. So when you think of the discounted cash flow model, you were pushing cash flows out a couple years and lowering the present value. So one of our airports was down about 16% in Q1, the other down about 10%. So marked down, as you would expect. But again, those were smaller parts of the overall fund. Today, airports are only 4% of the overall portfolio. So you've added even more in the regulated and contracted space and reduced that GDP sensitive allocation.
I see. Have in terms of the investment decisions and allocation decisions within your team, I imagine that a lot of it is predicated on sort of the deal flow that they're able to see, right? So given the size of the fund, its track record, I'm sure that plays to your advantage. Are there any, because this is a limited universe, right? There's only so many opportunity sets out there, so it's hard to really kind of gain alpha in any meaningful way because the information is all known. It's really about access. How does your team ensure its access to these utilities?
Yeah, I think barriers to entry is one of the most challenging parts of infrastructure. If you think about a regulated utility in the US, we own many of them at this point. But El Paso Electric, for example, the electric utility in Texas and New Mexico, it took us 15 months just to get regulatory approval after we won the deal. So we won the deal, we agreed to take the business private, and it took over a year just for the regulators to approve our ownership of an essential service business like that. The most exciting part about our deployment going forward is investment behind those existing companies. So one of the biggest challenges in infrastructure, you're going to do a new larger deal, and generally it's driven by an investment bank. You are probably competing with others to win the transaction versus CapEx at your regulated utility to make it safer, more reliable, to decarbonize it. All of that investment happens without competition. So for us to agree with the regulator in advance, to keep investing in those systems over time, to do those 3 things I mentioned earlier, happen generally at accretive returns. And again, that's where most of our investment opportunity will come going forward, behind the existing companies.
Okay. And I'm sure you have members of your team that are dedicated to managing and maintaining those relationships with the regulatory agencies, correct?
We do. And there's 70 people on our team solely dedicated to the fund, where we have majority control positions in nearly every company. And most of them, we have 100% equity control. So for us, we own all of the board seats in most cases. So you'll see one J.P. Morgan person on every board, and then 4 to 7 independent directors that we've put in place on every board as well. And those are all non-J.P. Morgan people. They could be former regulators, former airport executives, people that have specific expertise in a sector or geography. Again, much different than just having all private equity or investment banking background people on a board. Not much diversity of thought if you do that.
Excellent. Okay. I'd like to remind everyone that if you do have any questions for Chris, you can submit them via the chat. I just have a couple more for you, Chris, before we go to questions from the audience. But if you were to say, how is your team managing the transition from the traditional utilities to the newer renewable space? We know so much money is being poured into updating the grids throughout the country, switching to renewable resources. How is your portfolio positioned now and in the future for this transition?
Yeah, and I think one of the keys is this is not an impact fund for us. We are certainly invested in wherever the best risk-adjusted return lies, but our biggest opportunity today is easily the energy transition. So 23% of our fund is invested in renewables, so wind and solar, but we also have midstream. So we have a business in the Gulf of Mexico that transports gas into the United States. We have gas distribution, gas generation. That's where we like to think of the asset class as more of an all-weather solution, just given it's not focused on one sector, it's not dependent on a specific macro environment. So for us, you have a diversified set of opportunities. That being said, exactly what you mentioned earlier about the significant investment into the grid, the energy transition is not going to be simple technology investments like battery or carbon capture. It is going to be a complete overhaul of systems. And in our view, at least, the advantage in terms of the investment opportunity will go to those folks that already own the critical infrastructure and have the right to replace that infrastructure over time at accretive returns. So that's where, for us, the benefits of scale we think are significant. And just a few examples, the fund, as of 10 years ago relative to today, significantly more diversified from an asset and investor base. Returns have doubled and risk has been cut in half. So that's standard deviation and leverage coming down as well. So again, I think at least there's a lot of benefits to being a scaled player in the open-end infrastructure space.
Sure. And of course, especially when you're dealing with government entities. You mentioned that some companies you own 100%, but most of them you own a majority stake. Are your investments in these utilities only on the equity side, or are you also making debt investments as well?
Only on the equity side for us. So the portfolio companies will use leverage, but again, we are just the equity part of the investment. As of today, our discount rate is about 10%. So that would be your expected go-forward gross return based on the assets that we have in the portfolio today and today's valuation.
Sorry, you got cut off. What's your discount rate today?
10%.
10%, right. So that's what investors can reasonably expect on an annualized basis going forward, correct?
That's right. And that's what we use as our benchmark as a team to outperform. So when there's no perfect benchmark for the space, but for us, we use the discount rate of the companies and we want to outperform that by 10%. So that's the way we think about it as a team, obviously a little bit different from the way investors think about it.
Right. Do you anticipate volatility remaining the same, or the Sharpe remaining the same?
We do. We don't really expect much different. I think the key difference in some of these open-ended funds is the very beginning. So at the beginning of a fund, you have a handful of assets. Your first investment is 100% of your portfolio. You might have one regulator that can determine the entire return of your fund. That is extremely different today, where we have just under 1,000 assets, dozens of regulators, hundreds of counterparties, where we don't expect one big event to change the overall portfolio. So that's exactly what we want. It certainly caps your upside as well. But again, for us, that's not the purpose here. The purpose is compounding consistent returns.
Okay. And then one final question from me before I open it up. In terms of size, capacity, give us your current size, and at what point do you think you will close, or is there a point that you think that you doesn't make sense to really take on new capital?
Yeah, and the short answer is there's not an AUM size that we think about closing at. So we're at 34 billion of net asset value. We think about it as more of a company limit. So for us, we have 21 companies today. We want to think about the right number we can appropriately manage. So 25 to 30 is probably the right number. But for us, that will probably result in a company or two being sold, some being merged together, and maybe one new business a year. So for us, that growth will happen slowly over time. And the other piece with the AUM is once you reach 35 or $40 billion, just a year's worth of performance increases your NAV pretty significantly without actually adding any assets to the fund. So for us, again, we worry less about the AUM, more about the amount of companies.
Excellent. Excellent. Okay. So now I did get one question here on the sort of the key metrics of the fund, I guess asking for, you sort of mentioned, but maybe you can get into a little bit more detail, return yield, volatility, some of these measures.
Yeah, absolutely. So more recently, I would say in the last 5 years, for example, net returns have been in the 8 to 10% range. Yield has been in the 5 to 7% range, and volatility has been about 1.5%. So as a reference point, it's about half the volatility of fixed income in the same time period. But again, to be fair, even if you measure the fixed income volatility quarterly, of course, people can buy and sell, which is a little bit different from what you see in this portfolio. For us, that's generally the targets and expectations for us going forward. The key difference that we always like to talk about is the net multiple of invested capital. So for us, that is the best reflection of return for a portfolio like this relative to a closed-end private equity fund. So for those that have used private equity that has the kind of 15 or 20% IRR target, in a lot of cases, those are partial drawdown funds. So only a partial amount of your money is actually called over, let's say, a 3, 4, and 5 year period. So the 15 or 20% IRR looks great, but it's usually on a partial amount of your money that was actually committed and called. For us, this is always a one-time full capital call. There's no J curve. You're not paying fees while you wait to be called. And therefore, that 8% return is actually a 2.2x net multiple over 10 years. So we think that's attractive relative to almost any private equity fund in the market over that time period.
Yeah.
So again, always focusing on multiples, not IRR, would be the key theme.
Yes, it is. I can attest to that. I've seen other infrastructure funds as well. So those are quite attractive levels. Chris, one last question here. In terms of give us the minimums. I know the fund is coming to Insignio through iCapital. Right. What's the minimum to invest? Is there any lockup period? Exit just give us those details.
Yep. Yeah, absolutely. So the minimum is $100,000, which is nice because the minimum direct into our fund is 10 million. So this is really the first time we've been open to a different set of investors, which I think is great. You're getting access to the same exact portfolio. We have what's called a commitment queue. So once you commit to the fund, we accept commitments monthly. We call capital the first business day of every quarter. When you commit to the fund, again, you're not giving us any capital. You're not paying any fees. Think about it as holding a spot in line. We make an estimate to you as to how long it's going to take for that one-time full call. Right now, it happens to be one of the shorter commitment queues that we've seen. So 3 months or less is the estimate. So someone committing in October, for example, has an estimated full call January 1st. But when you do make commitments, we will, of course, make the estimate to you as to when we think it will be called. We have a 4-year soft lockup. So we offer redemptions twice a year. Everything happens on a best efforts basis. And there is a 4% fee during the first 4 years to redeem. The fee goes to the other investors in the fund. It does not go to us. And it was actually put in place by the larger investors in our fund. So they helped us put this in place. They don't want people trading in and out. So they want to make sure it's a long-term mindset investor. So after 4 years, no fee to redeem. We've honored 100% of redemptions in the 16-year history of the fund.
Excellent. Excellent. So if there's no further questions, I think, Chris, thank you for that expose into the J.P. Morgan Infrastructure Fund brought to you through iCapital, the feeder structure, which, as you all heard, Chris mentioned, has a $100,000 minimum compared to a $10 million entrance ticket into the fund directly. So I think it's a pretty interesting opportunity for some of your clients on the ultra high net worth side to benefit from what really is an institutional play. So we're very excited about this opportunity with iCapital. So Chris, I see we have no further questions. So thank you so much for your time. We hope we can speak to you again.
Excellent. Thank you so much.
Thank you. Insignio Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignio International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Public Advisor Public Disclosures website, https://advisorinfo.sec.gov/.